Today we're talking about your mortgage or your hopeful mortgage. And we're going to talk about why you should not pay off your mortgage early, especially if you've got a rate like 2%. It's like free money. And I will better define that through this video. And I really hope you hang on till the end because there's a part of this story, a part of the reason to not pay off your mortgage that a lot of the financial pundits don't tell you. Like this dude here. Yeah, that's Dave Ramsey. I was going to write a book that said what Dave Ramsey got wrong, because there's quite a few things. But let's look at the numbers and you be the judge. And don't forget, stay till the end, please. It's very important for your financial future. All right, so let's start with something simple. Let me share with you a possible mortgage someone might have. In this example, the person has a $100,000 mortgage. It's at 6% interest for a 30-year term. Given these parameters, the principal and interest would be $599 a month. If they make minimum payments only, they will have paid $116,000 of interest over the term. Now, I got this information from bankrate.com, and I am going to put that information in this description in case you want to do a calculation on your own mortgage or your own possible mortgage. But for now, we're going to use this nice round number of 100,000 because you can make multiples of it, right? If you've got a mortgage of close to 200,000, it would be twice this amount. That is, if you've got the 6%. We'll bring this all back to the 2% or the 4% mortgage in just a little bit. Hold that thought. So imagine, if you would, instead of making those minimum payments only on this mortgage, you decide to pay an extra $50 a month. In doing so, this mortgage would be paid off in 24 years, and you would have saved yourself $24,000 in interest. If you could turn that up a notch and do $100 a month instead, you'd have it paid off in 21 years, saving yourself $39,000 in interest. And if you can turn that up even more to say $200 a month, you are going to have that paid off in just 16 years and saved yourself $58,000 in interest. These are impactful numbers. Now, granted, you got to keep in mind, though, if your mortgage is 4% or 2% or 3%, your interest savings are even less than this, but still tens of thousands of dollars, and you're free and liberated from your mortgage payment, at least the principal and interest. The taxes and insurance won't be going away, and in fact, will probably be increasing, but at least the principal and interest would be gone in these terms. Now, I used to present this to a lot of my classes. I teach continuing education classes to insurance professionals and financial advisors, and I've done this for 25 years. That's why I'm bringing these ideas to you. So in the first few classes, we would just talk about this interest savings from paying off the debt early. And then one year I was incorporating it into some of the material, and I thought to myself, I wonder what you could make if you saved it instead. Let's take a peek at that. So, as you can see on the left-hand side of the screen, you see what we were just looking at. Paying an extra $50 a month, $100, $200, and the interest savings that you'd get on the mortgage. However, if we took that same $50 and applied it to a savings account instead, in the same 24-year period, we would have $32,000 saved instead of $24,000 saved in interest on the mortgage. If we take the $100 a month in the same 21-year period, we now have $51,000. Well, close to it, instead of saving $38,000 in interest. And if we take the $200 a month and put that in the savings account, we've now got $65,000 instead of having saved $58,000 in interest. The savings column wins. But our work isn't done yet. You see, my mortgage interest might be tax deductible. Now, in today's tax environment, and one of these days we'll dive into that too, but in today's tax environment, most of us have a standard deduction that's well above the deduction we would take here. So chances are we're not deducting our mortgage interest. But if that was the case, we might be sacrificing a deduction as we pay this off early. Our earnings on the savings side, well, that might be taxable. Now, we might be able to put that in a Roth IRA or other tax deferred accounts, but nonetheless, it might be taxable, diminishing the return. But I'd like you to consider this. If you have a 2% mortgage, those interest savings would be cut in a third. This is a 6% rate. So instead of seeing $24,000 in savings for the $50 a month payment, it's $8,000. $8,000. A third of $24,000. For the $200 a month, that's only $20,000 in interest savings. Even if you have a 3 or a 4% mortgage, these savings values are greatly diminished. And you want to know what else? The 6% savings that I put in this column is conservative compared to what people could have earned over the course of the last 4 years in the S&P 500 or other investments in the stock market. It's really important to remember that the stock market isn't going to be a winner every year. It's not. It is going to be a more volatile investment. But I will tell you, the S&P 500 over the long term has produced consistent results that exceed 7% a year. In fact, let's take a peek at that. What you're looking at here is just a quick Google search of values in the S&P 500 since 2020. Now, 2020 is when those 2% mortgage rates came around. Prior to 2020, like the mortgage I have was 2019, still 4%. Very low compared to today's mortgage interest rates. And look at these returns in the S&P 500. By October 5th, 2024, the S&P 500 was up 34% from the previous year. In December 2020, this was about the period of time that people were getting those super low interest rates on their mortgages. The value of the S&P 500 was about 3,700. This means over the course of close to the last 4 years, this value has gone up by 2,000 points from where it initially started, and that's about a 50% return. Now, I'd like you to think about this for just a second. Just a second. Keeping money borrowed at a 2% rate and working to pay that off, or take that extra money and try to get a 50% return. Now, it does not take a rocket scientist to figure out which one of these would be better off for you and your family. Now, getting back to the fact that the S&P 500 isn't a winner every year. It's not. But let's look at some historical trends over the long term. As you can see from the graph before you, this is what the S&P 500 was at the last day of trading. This would have been November 1st. It's in Espanol because I am living in Mexico. More about that because it fits into me being fearless with my finances. But if you're looking at this graph, you can also see that you can go back 5 years. As you can see over the course of the last 5 years, there is a little bit of volatility. It goes up and down. It doesn't stay up all the time, and it doesn't go up in a nice little ski slope. There is some volatility, and you will experience it. But I'd like to call your attention to a few things here. Here's the end of 2020, about where we were looking at for those values in the S&P 500 at 3,700. And look, it continues to climb. And then there's a little shakeup in the market and it goes down. And then we get to these closing amounts. I'd like you to consider this. If you are routinely setting aside $200 each and every month and dropping it into, say, the S&P 500, there are times then that you will end up buying high, and there will be times where you end up buying low. This will also help your return in the long run. So those are the numbers, and the numbers matter, and the numbers make sense. Don't pay off your 2% mortgage. Don't even pay off your 4% mortgage. Save it instead. And here's why I asked you to hang on. There's a story I want to share with you about why it's even more important to save this versus pay your debt early. You see, while I'm paying my debt early, I don't have control over that money. I'm giving the bank, the lender, an extra $50 or $100 or $200 extra a month, but I can't get that back. The bank gets to keep it. And what really helped me understand this was a story from a friend of mine. Back in 1990, we're rolling this back, okay? Good 30 years. Back in 1990, her and her husband bought a home. And at that stage of the game, interest rates were a lot higher than they are today. About 10%, I think, was their first mortgage. At least I think that's what she told me. The interest rates of the 1980s, super high, very high. This was to try to curb the inflation that started in the 1970s. If you haven't yet, watch our video on inflation. I'll put the link to that in the doobly-doo because it's really important to take some of these things in historical context. 2% mortgages probably will never come around again, not in our lifetime. So hang on to it. Anyway, back to my friend and her 10% mortgage. Her and her husband decided that they would pay extra on the mortgage each and every month to get that paid off early. And they did. Never missing a mortgage payment, paying in extra whenever they could. $50, $100, $200, sometimes even $300 or $500. Now, over the course of the 90s, interest rates started to come down. One of their last mortgages was at about the 7% range. So even when you look at what you might consider high interest rate mortgages today, historically, it's pretty normal. Definitely normal. Okay? But I understand how you want to get the lowest interest rate possible. Makes good sense. And so, yes, as their interest rates went down, they would refinance. And many times they'd also take out a little bit extra to maybe do a home repair, etc. So the debt never really shrank that much. Everybody with me? Now, along comes 2007, and my friend gets a divorce. She makes more money than her soon-to-be ex-husband, and she decides to buy him out of the house. Now, you might not have lived through it, or maybe you did, but the 2008 financial crisis was all about mortgages and housing prices, right? Now, this woman was savvy. She knew that the value of her home was elevated due to all of this, but she was still willing to buy her ex-husband out. More so for the stability for the kids. She didn't want to have to move the kids, and she was willing to pay for it. So she bought him out of the home. At that time, it was appraised for $450,000. She ended up giving him his share of the equity, which was about $125,000. And now she has a mortgage at $300,000. And everything's chugging along fine because she makes some pretty good money and she keeps on with the trend. She's going to make every payment and she's paying extra. She feels like she's getting somewhere. And then comes the crash. Now, the value of that home where it was set at about $450,000 dropped in about half, which effectively meant her ex-husband got his equity and she just lost hers. Everybody with me? But she figures that's okay. She's got the money to pay for it. Her kids are safe. Everybody's okay. And as you can see, I'm getting a little teary-eyed about this. It's 2008. She lost her equity. Boom, gone. But she still got a good job and she's still making good money. And in fact, her income keeps going up. She is okay, and so are her kids. But then she loses her job. This happens at about 2010, and it takes her a while to find a new one. I can't remember what she told me. It was like 8 months, a year, and the new job wasn't anywhere near what she was making before. This was all because of the recession that followed. Now, she went to the bank and she asked the bank for something called a modification. Back in those days, there were laws in place, and there still kind of are, that if you suffer a financial hardship, the bank will reevaluate your loan. Well, she was having a financial hardship. And I want you to remember that it is now 2010. She has been paying on this mortgage for 20 years now, always paying and paying extra. She has been a good banking customer, and she feels like the bank will probably treat her well. Well, she gets her modification. You want to know what it was? They dropped the interest rate 0.25%. Now, if she could have qualified for a brand new mortgage, interest rates were now 2% lower than what she had. But the bank only gave her 0.25%. And you know what else the bank did? They took her 30-year term and made it 40 years. This means she'll pay more interest over the entire term. This dropped her payment. I can't remember all the numbers, but by about a 25% amount. This to a woman who now has an income that's 40% less than what she had before. Yeah, that's what she got for paying extra to the bank. She tried for 2 other modifications. Each subsequent one was worse than the first. She tried to do something called a short sale. I'm not sure if you're familiar with this, but this means that you try to sell your home short of the debt that's owed. The bank has to agree to this because of financial hardship. Well, that $300,000 mortgage that she had, she couldn't even sell it for $180,000 in 2012. A house that was valued at $450,000. She also tried to do something called a deed in lieu. Under a deed in lieu, the owner signs over the deed to the lender in lieu of debt forgiveness. Now, many times under a deed in lieu, because foreclosure, by the way, is expensive to the lender will offer the homeowner some lump sum to give them an incentive to do the deed in lieu. It's essentially the money that they would have spent under the foreclosure. So this lovely single mom was hoping that she might qualify for at least that. No, she didn't get a lump sum. The bank asked her to sign over the deed and pay an additional $17,000 to have the benefit of leaving her home. Not kidding you. This is all very true. So when I say don't pay off your debt early, this includes your car, your mortgage, anything. Put it in a savings account instead. When we have money saved, just like it shows in this column to the right, we have power, we have control, we have options. When we pay money to a lender, extra money, they have the power, they have the control. When that lovely single mom turned to me and she said, Renee, I regret every dollar I paid extra on that mortgage. If my kids and I had kept that, we'd have something today. Instead, she lost that home to foreclosure. Well, thank you for staying toward the end. It was worth it, wasn't it? I think I might actually make a separate video just with that story, because honestly, that's what changed my mind about all of this. And I think it's the reason why it's so important to save first. It's the best way to get fearless with your finances. Do me a favor, subscribe so that you get more videos just like this. Like this video and please comment. If you've got any questions or other things that you'd like me to talk about, I would love to create videos that are important to your adventure in finances. In the meantime, be fearless and have fun.